I don't know if you caught Steven's most recent video about 6 reasons to buy Disney stock. It's pretty good, you should check it out. But when you're evaluating a stock, it's easy to just put your blinders on, only look at all the good things the company has going on, and create a compelling narrative about the stock's future. People do that all the time. Creators here on YouTube do that all the time. But you can't do that and be successful long term. So if you see anyone doing that, heed their advice with caution. And I'm not about to let Steven get away with this. So in this video, I'm going to take you through a couple of the biggest concerns that I have when investing in Disney that you should definitely keep top of mind as you make your decision. Coming up. Hey there, my name is Steven Spicer, and it's my goal to help you invest smarter. Now, if that's your goal here as well, then go ahead and subscribe right now if you haven't already. And if you missed my other videos on the Disney company, you might want to check them out first. The playlist link is in the description. And if you're looking for my full investment report, well, stick around until the end and I'll let you know how you can get it all. Now, if one's looking for reasons to not invest in Disney, you could break out several of their divisions and find problems or concerns with even some of their larger assets, like ESPN, for example. Disney, over the last several years, has been trying to navigate the complex changes that are happening in the sports broadcasting space. And their performance, well, everyone in this space's performance, has been called into question for one deal after another. Companies are forking over more and more for exclusive rights, and since we're entering uncharted territory for the space, it's hard to know if they're overpaying or not. For several deals, at least, it certainly seems that way, but I guess time will tell. But picking apart the niche problems with some of their divisions is not the point of this video. I want to highlight a few much more significant concerns that I have. Concerns regarding the company and the stock price that you should consider before taking any position. Here are my 3 biggest concerns with and potential reasons not to own Disney stock. The first is that after their upcoming merger, with 21st Century Fox, they'll have twice the long-term debt load, increasing from $17 billion to more than $35 billion, making their annual interest expense around $2 billion. Now, if both companies continue to perform as they have in the recent past, this should be manageable. But if their merger does not take as planned, if the expected synergies are not achieved, or on a broader scale, if there are unexpected macro changes that significantly and negatively impact the revenue or profitability of these businesses, then this fact of their increased debt load and interest expenses should be top of mind for any investor. And that leads right into my second concern with owning Disney stock. Massive mergers like these often fail. Anecdotally, you could think about the disastrous $165 billion AOL Time Warner deal in 2000. But it's much worse than just one mega mishap. In fact, KPMG, one of the big 4 auditing firms, conducts a survey every 2 years of company mergers and consistently finds the same results. Most mergers fail. More specifically, only about 1/3 actually go on to increase shareholder value. Another third remain neutral. And the final third actually reduce shareholder worth. So sure, it's easy and fun to consider all the synergies that these 2 corporations might have, but it's one thing for a large conglomerate to acquire or merge with a much smaller company, to take it in and try to seamlessly fuse its employees, its assets, its processes, everything into the larger company's existing corporate culture and ethos. That's one thing. That's a challenge, to be sure. But it's another challenge altogether when the company being taken over is a $90 billion conglomerate itself. Although in our heads, perhaps because most of us are only exposed to the end products of these 2 companies, we like to think how like 2 pieces of a puzzle how easily and beautiful these two should snap together. But it won't be like that. It'll be a colossal challenge against the odds, and honestly a triumph if they're able to make it all work. Instead of two little pieces easily snapping together, it'll be like trying to fit together an entire enormous puzzle with tens of thousands of moving parts. Now, to be fair, like I mentioned in my last video, which if you didn't see, you need to, the link's in the description, I think that they have everything going for them to make this work. Specifically, that experienced management team that has successfully integrated several companies over its tenure, which we talked about 2 videos ago. So maybe just check out the entire Disney playlist. So I like to think that it's going to work. I'm optimistic in this case. But it would be naive of me to deny the facts. There have been previously successful management teams who have failed in the past. And like we've seen, statistically, the odds are against them, especially when you consider the size and scope of what we're talking about here. When you couple this realization, the possibility of a post-merger reduction in shareholder value, with the first point that I mentioned, their increased debt load becomes much more of a concern for investors. What do you think? Do you think Disney will be able to beat the odds? Let's talk about it in the comments. I'm curious. Now, those are the 2 biggest concerns with Disney stock over the coming years. But my third point for this video is a consideration that I believe investors should understand before taking any position in Disney. A lot of the reasons to invest that I provided in my last video are well known. I mean, they're not new information, which means your opportunity for any sort of edge over the rest of the market is limited, or perhaps non-existent. What you're doing here is essentially casting your vote. How do you think this will all play out? As I explained in excruciating detail in a video I did for Ryan Scribner's channel, when there are significant opportunities coming up for a company, like Disney's big box office lineup or their robust park expansions, etc., that's all already priced in. It's not a secret. Now, if one of their expected home runs is a flop, that'll hurt. And of course the opposite is true if one does significantly better than expected. But it's hard to really gain any sort of edge with widely public information like that. So be careful when you hear people touting that as a reason for the stock price to soar. Unless, for example, they have some specific reason, some insider knowledge, some reason to believe that the box office performance will come out way ahead of projections. Then there might be some reason to invest. But when it's widely public, everyone knows that. But where a short-term trader, especially, or a weak-stomached long-term trader, needs to be careful is when there are big questions about how well something is going to work for a specific company or how it will affect a particular stock's price, like this massive merger.
Merger? A merger?
That's a big question mark. Like how Disney Plus will actually stack up against Netflix and the many others, and so on. There's a lot of information there that no one will know until it actually plays out. So the only thing investors can do is essentially cast their vote. So as more investors pile in, saying that they think the merger is going to take.
That's right, looks like we're about to have a merger.
And provide the expected boost to Disney's top and bottom lines, they go long. And at the same time, there are investors taking the other side of it, anticipating that things won't go well, so they go short. All the while, the stock price hangs in balance somewhere in between. Now, it stands to reason then that as those big questions start playing out, and we actually see the merger is increasing profitability, for example, or not, that's when we'll start to see significant fluctuations in the price of the stock. If that doesn't make sense, definitely go check out that video on Ryan's channel for a full explanation of this concept. Of course, I'll put the link in the description. My point is, since there are several questions and unknowables floating out there, I would not be surprised by, relatively for Disney, elevated volatility over the coming years, up or down. So my concern, my caution to you is if you're considering a position in this stock, prepare yourself for some volatility, at least over the next year or two. If you understand what I'm saying and feel prepared, that's great. That makes me happy. My job here is done. I hope you let me know by hitting that like button. Now, honestly, I'm optimistic, but with the way I'm investing in Disney, I'm also prepared for the very real possibility of some prolonged downside. Now, in our insider community, I released a video about exactly how and why I would consider trading Disney stock, including explanations of a couple different ways to structure your trade or investment depending on your goals. I also emailed a portion of that assessment to everyone on my email list, so if you're interested in seeing that full report, or at least the full report of the most recent stock I've covered, plus all future ones, go to spicercapital.com/stock. I'll send it right over. I hope the information in these last several videos helps you not only come to an educated decision about whether or not Disney makes sense for you as an investment, but also helps you become a smarter investor with the way you evaluate and analyze stocks. That's my goal here. So if you aren't already, I hope you'll join us by subscribing. I look forward to getting to know you better and helping you however I can. Take care.